Before we introduce divorce, just general mortgage guidelines, there's three main ways that lenders look at a borrower, regardless of marital status. We have credit, we have equity, we have cash flow. There's also some additional items we look at that I call the minor items, such as job history, assets, property type, occupancy type, loan amount. But for now, we're going to focus on the three main categories: credit, equity, and cash flow. Then we're going to insert divorce into that whole equation. So we all know credit scores matter. The higher the credit score, the better. What you may not know is what goes into the credit score. This is a pie chart accounting for 100% of people's credit. For time purposes, I'm going to identify the two biggest pieces of the pie, which account for about 2/3 of the overall score. So the first one, the biggest piece of the pie, is payment history. It accounts for 35% of your score. So quite simply, pay all your debts on time, you get an A+ in your report card for 35% of your grade. But what if you're late? There are three different ways, the computer algorithm that does credit scoring, three different ways that it analyzes a late payment. We have recency, frequency, and severity. I'm going to define what these are, and I'm going to ask each of you to raise your hand and vote for the one that you think has the biggest impact on score. Recency, how long ago were you late? Frequency, how often were you late? Severity, how late were you? So show of hands, how many of you think recency has the biggest impact on scoring? One person, two people. How many of you think frequency? Okay, much more. How many of you think severity? Okay, so in your poll, frequency won. Not to bum you out, but it's not the right answer. But you can make a case for any one of these, but the right answer is, drum roll please, recency. Because of one word. It's kind of a funny word. It begins and ends with the letter M and has an M in between. What's that word? Momentum, or lack thereof. So there's two different ways we can look at that. Kind of the positive, glass half full way, which is, hey, time heals all wounds. That late payment I had back in college, it's not going to affect us anymore unless you just got out of college, right? The glass half empty. The negative way is you can have years, even decades of perfect credit, at least temporarily ruined by late payments. So let's now bring in divorce. A lot of these couples have joint debts. Sometimes people don't pay their debts on time, accidentally, because they're not communicating at a high level, and sometimes they don't pay debts to be spiteful. I had a situation where I had a client who said she had a credit score in the mid-700s. I pulled it, wasn't mid-700s. She had perfect credit history for the whole 7 years up until the last 2 months. All 5 of her trade lines were now 60 days late. I asked her what was going on. She says, my attorney said not to pay my debts until my ex plays ball. Far be it from me to get in the way of communications and strategies with your attorney, but you no longer have an option to borrow money anytime soon. So this is an example of where divorce can sometimes intersect with our guidelines. Now, the second biggest piece of the pie is credit utilization. Think of credit cards. We all know how credit cards work. You have a credit limit. You charge up your money, pay it down. That's your balance. Every single time your balance is charged up or paid down, that affects your balance. Once a month, your creditor reports your balances to you in your monthly statement and sends those same numbers to the credit bureaus. Then someone like me pulls credit and I see what the most recently reported balances are. The more you tap into your credit card, the higher your ratio of utilization, the more it hurts your score, the lower the better. Let's bring in divorce again. Let's say I have a divorcing party meets with me in January. Just getting started with the whole idea of getting divorced, wants to get an idea if they have a chance of keeping the marital home. We weigh in January based on what we see. Say they have one credit card, Capital One, $20,000 limit, balance is $2,000. They're using 10%. That's a lot of restraint in this example here. They're going to score high on this 30% of their score. Let's say I weigh in on whether they can be approved, and they say, okay, great, I'll get back to you when my divorce gets closer to being done. We don't speak until September. We need to update the exhibits in the file. I need to repull credit. What if I see that Capital One now has a balance of $19,500 on it? It's going to weigh down the 30%. So here's where divorce becomes just another factor here. Oftentimes, one party moves out of the marital home. Regardless of which person is our borrower, they may have some shopping to do to backfill needed furniture, appliances, audiovisual equipment. And a lot of them also put their attorney fees on their credit card. I'm not suggesting we don't pay the attorneys, but if we start tapping into higher ratios of utilization, we start tanking that 30% of the score. I have a lot of folks that have perfect payment history in that first slide, but bring down their entire 30%, and they're sitting at scores in the mid 600s right now, and they can't figure out why their score is so low. That's almost a third of your credit score, those balances. So you can kind of see where this becomes a thing. Let's move on to equity. This is an example of a divorce equity buyout, which is the main type of loan that I am brought in on, typically early in the divorce process by folks like these attorneys here, to figure out if we have the ability to let one spouse keep the marital home. In this example, we have a property value of $500,000. Title is in both of their names. We have a mortgage payoff of $400,000. The loan is in both of their names. Therefore, they have $100,000 of equity. Let's say that she desires to stay in the home. We call her the in-spouse. She's staying in the home. He's moving out. He's the out-spouse. Again, nice gender-neutral terms here. Out-spouses typically want two things in order to agree to give the in-spouse the home. Condition number one is remove me from that debt. That $400,000 loan, I don't want to be a part of that debt anymore, so get me off of that loan. Condition number two, I want my divvy. It's $100,000 of equity, I want $50,000. So in this example, she is seeking a new loan for $450,000. I'm leaving out closing costs for this example. So question for you, what is the current LTV? Current is $400,000 divided by $500,000. 80%. What is she desiring when she gets her additional 50? 90%. Sounds pretty easy, right? On paper, this should be no problem. Let's just do the paperwork and get it done. But here's where we have issues with mortgage guidelines as they pertain to divorce. There are two different categories of refinance. And I'm citing Fannie Mae and Freddie Mac here today. So not my company, not the company next door, Fannie Mae, Freddie Mac that create these conforming or conventional guidelines. The first type of refinance is called rate and term. The second is called cash out. In this example here, we need to go up to 90%. The max LTV is 97%. Game on, we're in good shape, right? But the max cash out is $2,000. We want $50,000. Let's move over to cash out then. Unlimited cash out. Now we're talking, but we're capped at 80%. We're already at 80% before she pulls any money out. I'm not throwing mud at my competition here, but there are a lot of untrained mortgage professionals, especially working in these inbound call centers, that would simply look at this and say, she wants more than $2,000 and she's above 80%, no loans available, she needs to sell the house. So there's people across the country getting bad advice that are literally selling their house, moving their kids out of their house for no reason whatsoever because they're talking to people who don't know the guidelines. So there is a way to call a divorce equity buyout a rate and term refinance. There's some certain conditions we have to maintain. We do this quite a bit where we're pulling significantly more than $2,000 out, and yet being able to call this rate and term. So again, a big reason why we want to bring in CDLPs in these situations, and they're all over the country here. The CDLPs are trained on how to work with the attorney and the divorcing spouse to be able to craft the guideline or the orders in a way that Fannie and Freddie will call this rate and term. Lastly, let's look at cash flow. A lot of us know about debt to income ratios. This measures projected cash flow. It's another fraction. The debts go on top, the income goes on the bottom. You divide the two, we get a debt to income ratio, or DTI. In the world of Fannie Freddie, we max out at 50% DTI. So anything above 50% is a decline due to excessive debt to income ratio. What goes into that fraction? Well, the top of the fraction, we look at the proposed new housing payment. At the very least, we have PITI, right? Principal, interest, taxes, insurance. We may also have PMI, private mortgage insurance, Mello-Roos, HOA dues. Whatever that whole housing payment is, we're using that number on the top of the fraction. We pull credit. What do we see on the credit report? Minimum payments due for credit cards, auto loans, and/or student loans. We just call that consumer credit. We take the minimum payments of each of those unless they're being paid off ahead of time. We divide that by the income. Now you see in red font here, I've accounted for what happens when divorce is present. If our client is the payor, the one making the payments, that payment goes on top of the fraction. If our client is the payee, or the one receiving the payments, that income might be able to be used on the bottom of the fraction. I'll qualify that statement in just a moment. So let's look at an example here. For easy math, the client makes $10,000 a month. The proposed new housing payment all in is $4,000. Consumer debt is $500. We would do the math as follows. The $4,000 plus the $500 is $4,500 divided by $10,000. We're at a 45% DTI, or debt to income ratio. All things being equal, we have an approval now based on DTI. Now let's bring in divorce. If our client has to pay $2,000 a month, all of the other numbers are the same here. We now take the $4,000 housing payment, the $500 of consumer payments, now the $2,000 support payment. We're at $6,500 divided by the $10,000. We're at 65% DTI. That's a decline on the loan application. And last but not least, let's say our borrower is the one receiving the payments. And let's say we're using that income to qualify. Now we have the same debts, the $4,000 and $500, it's $4,500 on top. We're now adding the $2,000 to the $10,000. We're at $12,000 in income. Our DTI is 37.5%. We're easily meeting the criteria here. Now, in this example, we didn't need the support income to qualify, right? We're at 45% before that income was even considered. But what if our DTI without the support was over 50, and we needed that income to bring the DTI below 50? We have what we call the rule of 636. The first number, the 6, refers to the minimum amount of months of historical receipt of that income. Lenders want to document that the payor is paying the payee as agreed. 6 months minimum. We also need 36 months of continuance into the future with those payments lasting. So it's not one or the other, it's both. So if we have a total of 3 years of support payments, we meet the 6 but not the 36. So with that in mind, we want to look at the 36 months a little bit closer, right? So in this case, if we have, let's just say he's paying her, and the agreement is he's going to pay her alimony or spousal support until one of them gets remarried or passes away. It already meets the 36, because we lenders can't come in and say, well, what if she dies beforehand? That's not for us to say. We call it perpetuity. It automatically meets the 36. But what if it has an end date? I'm paying you till our child turns 18. Child's already 16 years old. We have an end date before 36 months. Or on spousal support, sometimes it says, I'm going to pay you until January of 2025. We don't have the continuance needed. So these 4 bullet points here are very important. It all begins with clear and concise written orders. Underwriters are not going to fill in the blanks for you. Okay, so underwriters come to work every day fearful of them losing their job on a file that they approved 9 months earlier. So has to be clear. When attorneys are present, oftentimes it is very clear. But even to the point where, say there's 2 kids, one's going to age out in less than 3 years, one's going to not age out, what is the divvy for each of the kids? If it's $6,000 total, do we assume it's $3,000 each? What if it's $1,000 and $5,000, or 2 and 4? So the clearer we can be on the orders, the less the underwriter has to go out on a limb to approve that loan, the better odds we have of getting that loan approved. So non-ambiguous, clear orders, identifying who the payee is, who the payor is, the amount being paid, when it starts, when it finishes, at the very least. Signed and dated by all parties, fully executed. The money that's being paid has to be audit trailed. Okay, so no cash payments. Let's not use Venmo or PayPal or all the other different apps, because they don't have the same type of documentation on there. We want to see it coming from an account to another account. When I say that, by the way, it can't come from a joint account in both of their names to the one person, right? So say he's paying her, the money can't come from a joint account in both of their names over to her because she's paying herself as far as we're concerned. Has to come from an individual account. We have to be able to trace that. Now, no bartering. So let's say he has to pay her $6,000, but this month he covered the bill for the gardener and the pool guy. He paid $500, and he says, I'm just going to pay her the remaining $5,500. We need to see that agreed upon amount coming in every single month. In that situation, if he wants to, or she wants to kind of equalize him, she could write him a check separately for $500. But if the agreement is $6,000, we need $6,000 coming in every single month. Don't expect the underwriter to go and look at your bank statements and go, oh, well, he paid the gardener this month. We're not doing that. So pay as agreed if you want that income to qualify. Last one here, no netting out. Let's use a bigger number. Say he's paying her $10,000 a month. And he says, well, I'm going to pay all the bills first and give you what's left. I'm going to pay the mortgage, the kids, doctor bills, soccer practice, or whatever, karate. I'll give you what's left. We have no way of knowing what that money is. So in that situation, it's better to have him pay her the entire $10,000, and then she sets up payments out of that money to pay those debts. Sometimes there's a bit of a clash between life logic and lender logic. This is what's going to be used when you pursue this in place. Because in the end, the income has to be consistent and stable, paid as agreed each and every time if you want this to be used for qualifying income. With that in mind, once somebody files, the petitioner files for divorce, even if the respondent has not yet been served papers, it becomes county record. We pull public records and we see this pending divorce, we view it as a pending lawsuit. We're not going to make any assumptions on how that lawsuit's going to play out. It's not for us to say, oh, well, he's working, she's not, there's no way she's going to have to make payments to him. We're not going to assume this. We can't weigh in on the DTI until we know whether our client has to pay any support payments. You don't need to be divorced officially before the loan gets done, but we have to at the very least know if our client has a debt being created by this divorce. So we're going to freeze in that situation. Sometimes if I'm brought in early before the divorce is actually filed, sometimes we get the loan done beforehand. Perfect example here, I had a very affluent couple. They owned a $4 million property free and clear. She was going to be the in-spouse. He wanted to buy a condo, high-rise condo downtown, $800,000. They met with me on the way to go file for divorce. Their agent said, hey, before you go, just talk to Jason just in case. I said, well, if you follow through on your plans and you file, this afternoon, pending divorce, pending lawsuit, we're going to freeze. If you can wait, I can do a cash out refinance on your $4 million property, give you $800,000 within the next month, go pay cash for your home, and then go file. And you can equalize how you want to equalize if that's what you want to do. They did that. I talked to that agent about a year and a half later. It turned out that amicable divorce was not so amicable down the road here. And a year and a half later, they were now just War of the Roses fighting. But he had been in his condo now for the last year and a half. He had made $70,000 in equity since he bought the property. So sometimes bringing me in early, there's value on that. Otherwise, if one person does file, it is what it is. We have to wait until the pending lawsuit is a bit more identifiable. Last but not least, I get some friction here sometimes with some attorneys, not these three here, but about, hey, look, we could hash out some common sense negotiations in our break room here. Lenders, what's wrong with you? Okay, go back to that example of the equity buyout. What if that $400,000 loan was at a 2.5 interest rate? And she's trying to get a new loan for $450 at 7.5. Wouldn't it be easier just to remove him from the existing loan and assume the loan, have a novation? That's an example of what the courts, the attorneys, the divorcing parties, that you can't force that issue. You can't force banks to breach existing contracts. You can't force banks to lend to someone because it makes sense for your case. So very important to know this here is that the courts cannot breach existing contracts or dictate business practices. It's a tough one because I get those conversations a lot and I understand why it would make sense, but it doesn't always make sense.